Hey, good evening. How's everybody?
Good evening, Professor.
Hey, good evening, Anna. I see.
Hi,
Uh,
Professor.
how are
Good
you,
evening.
Imani?
Okay, and yourself?
Good. I'm good. I'm good. Just, very hectic, living a very hectic life.
Mm,
Um, I see five people in the collaborate session, and actually, there are more than five people. Before I came in to collaborate session, I briefly checked the number of people in the. I'm not sure. It looks like I'm not sharing the screen yet. So give me let me share the screen. Start. Uh, okay. So, alrighty. So the screen is being shared now, so you should be able to see what's going on my screen. And this is number of people in the discussion board, and I have 10 people in the discussion board. So half of them are not on the collaborate. Um, that's fine. I mean, the collaborate is only a review. It's not the main lecture. And always keep in mind the main lecture is delivered through the pre-recorded videos, and we are actually today, as of today, the main lecture is done with um, with the equity valuation. Okay, the main lecture is done with equity valuation, and we are actually today we're actually um, starting on bond bond portfolio management, right? Um, this is a little more mathematically advanced, and uh, so the main lecture we are, just delving into bond portfolio management one and two, and um, that's just the start. And because we are done with the first two topics, we're done with the first two topics. It's about right time for our first test. Okay, first quiz. Normally, we are kind of behind because this year because of holiday schedule, um, we had a week off, right? And so normally about this time, the you will have to have the first quiz. Uh, so let me show you what I'm talking about. So we had, after September 2nd, 1 week apart, 9th, and then 2 weeks apart, right? Uh, we had, 2 week gap, right? And then we are here today. So as I said, normally, without that 2 week gap, we would have already by tomorrow, at least, this is the first week of, this is the first week of October. So normally by uh, Friday, October 1st or Friday, October 8th, we would have the first quiz. But because of the 2 week gap, then we will have, the first quiz will start on October 15th, right? The announcement will go out. The announcement will go out. It's already built in. but the announcement will go out tomorrow. Okay, I have already it is already built in here, right? The announcement will go out. It's going to go out on Friday, October 8th, 12 a.m. So, all right. So you will see, you don't see this just yet, but you will see it, right, tomorrow. And you will get also the email notification tomorrow. And it's on Connect. It will be visible also on the 15th, right? A Friday. Yeah. This is not right. 15th. All right. All righty. So that's it. Okay. Now, so we're gonna still how many people? Oh, there's now 14 people, and in the Collaborate session, how many people? Only 7. This is half the class is not on Collaborate. Okay, but we always have the few good people, right? We always have at least few good people in the Collaborate session, right? So we need to continue. We will continue the discussion from where we left off last time, and we talked a lot about the in the last class. We talked a lot about the how to determine, which how to determine whether the stock is overvalued or undervalued, because that's basically your long-term investing. Long-term investing. If you buy and hold, in other words, if you're in a long strategy, then you would always want to find the stock that is undervalued, right? So we talked about, to see if the stock is undervalued or overvalued or justly valued, right? Correctly valued. We need to, inevitably, we need to find the intrinsic value, right? And there are 4 models for finding intrinsic value, right? And then whatever it may be, right? Something's missing here. Whatever it may be, right? We can always look up the market price, because market price is always published. We always get. But what's important is the intrinsic value, right? V0, right? And intrinsic value is, most of the times there can be 3 possibilities. Intrinsic value is greater than market value, or they are equal, or intrinsic value is less than market value. If the intrinsic value is greater than the market value, that means market is undervaluing, market price is undervaluing, right? Market price is undervaluing this asset. So this asset is undervalued, right? If the market price is greater than the intrinsic value, then this asset is overvalued, right? my mouth is so dry. It's hard to. And if it is overvalued, right? It's clearly not a buy target. If it is undervalued, it's a buy target. Everything is like that. Think about it. If anything is undervalued than its intrinsic value, it's a buy target, right? Common sense. You're looking at a, there is let's say, iPhone, I don't know, iPhone 13. I mean, what is the latest model? But when iPhone 10 came out, it was like $1,000, right? iPhone 10, when iPhone 10 or 11 came out, it was like $1,000. Of course, I can't. We don't. It's hard to tell what is the intrinsic value of iPhone 10. Intrinsic value would be not more than like $200, $300. But anyway, there is no way you can buy iPhone for $300 or $400. So the market price of iPhone 10 was 1,000. But somehow, I mean, that's the market price. Intrinsic, it's always overvalued, right? It's always overvalued. But let's say so this analogy may not be the accurate one, because iPhone 10, if iPhone 10 was selling for $1,000, that's not intrinsic value, of course. Clearly, it's not intrinsic value. But let's say $1,000 is intrinsic value, but somehow, and the price cannot be different from one Apple store to another. They all have the same. And Apple iPhone is sold only through their Apple store, so it's like a direct marketing, right? Apple is not selling phones through Best Buy, or they always sell through Apple store. So the price would be homogeneous everywhere, right? Price would be equal everywhere, the same thing everywhere. Now, then Apple somehow you found an Apple store for and it's not likely to happen. But let's say you went to some upstate New York, some small town upstate New York, and they have Apple store there, and by fluke, somehow their system was briefly offline. System was briefly offline, and the price was suddenly, iPhone 10 price in this store was suddenly, $800 for some whatever, by technical by glitch, right? By glitch. Then obviously this is undervalued, right? I mean, if you're from New York City or anywhere else, you would know this is undervalued. But on their system, it appears as 800. Then what do? You would definitely buy that phone there. You won't buy only one. If possible, you would buy 10, buy the dozen, because if you pay 800, it's undervalued, and you can keep one for yourself. You bring it to New York City, sell it for even 900. You still make $100 out of it. Well, you can still sell it for 1,000, right? I mean, so this is why you're looking for an undervalued asset. Okay, and I gave you the logic. Either also you can tell by looking at the price, you can tell whether it's undervalued or overvalued, right? And also by looking at required return, looking at the required return, and expected return, right? By looking at, and I said only in equilibrium, intrinsic value and the market price will be the same, just like that. only at equilibrium in required return or cost of equity or market capitalization, they go by different names. Market capitalization rate or required return or cost of equity, they mean the same thing. And only at equilibrium, they will be the same, right? Expected return and required return will be the same. But if the expected return is greater or expected return is less than the required return, if the expected return is greater than the required return, then that it's undervalued. The stock is undervalued, right? And vice versa. So I don't know why I drew this here. Oh, I see. There was not. I see. There was not the inequality sign. It was not the inequality sign, but that simply means this discount rate is this required return. All right. So then now coming back to our four valuation models, right? First, we talked about first model, which is a constant dividend model, right? The constant dividend model is also called zero growth model. It goes by. Suddenly now it's hard to even. Okay, do I sound clear enough? Do I sound clear? My voice,
Yes,
my voice,
Professor, you're very clear.
You sound great.
I don't. Yeah. Hopefully, I won't. I don't have to. I just wish I don't have to exert too much effort because my voice.
Feeling sick?
No. I just can't speak loud. And if I speak loud, then look, you don't. I don't know if you ever understand. If you speak, for someone like me, whose profession requires a constant speaking, right? After speaking like 4 hours in a row, 3 hours maximum is 3 hours. Then your voice is hard to. Your voice is not like well regulated. You can't the tone of the volume and the tone is kind of shaky. It's not. And then because some people project voice from from their abdomen, abdominal breathing or whatever. I can't do that. It comes from my diaphragm, and so diaphragm gets because you have to squeeze the air out of your lung, so diaphragm does that, and it gets so tired. It feels like there's barely a gasp coming out of your throat. It's barely a gasp or whimp coming out of your lung. So we know first of all zero growth model or dividend constant dividend model, they mean the same thing. Zero growth model or constant dividend model or perpetuity model, it's the same thing, right? Intrinsic value at time zero is the dividend, because because it is constant dividend, there is no time subscript, right? You need a time subscript when dividends are all different, right? Dividend at time 1, dividend at time 2, dividend at time 3. In other words, dividend and time subscript, right? Dividend subscript 1, dividend subscript 2, dividend subscript 3. These are necessary if the dividends are different at every period, right? Those time subscripts are not only to distinguish, not only to tell that these dividends are at different time, at different periods, but also the time subscripts are there to tell that the those dividends are different from each other, right? It's a not only a time marker, but also it differentiates one dividend from another. But if the dividends are constant, right, not growing at all, in other words, then it's a perpetuity, right? Then we don't need to put time subscript because dividends are, the same every period. Okay. So let's go to okay. So this is what zero growth model originally looked like. First of all, first dividend, you will have to discount it one period back. Second dividend, discounted twice. Third dividend, discounted 3 times, right? And keeps on going until to infinity, right? This means, dividend at infinity minus 1, infinite time, right? Minus 1. And dividend at infinite time plus price of the stock at infinite time. And we discount it, infinitely. We discount it by 1 plus k raised to infinity. That means, discounting in. But then suddenly this is kind of a leap of faith. This is a leap of faith. Why? Dividends losing the time subscript, it makes sense. I mean, as I said, we don't need time subscript because all these dividends are the same, right? We don't have to use time subscript anymore. But then suddenly, out of blue, suddenly, where did this k come from? I mean, wasn't it k, 1 plus k? I mean, we're discounting it by 1 plus k. I mean, how come suddenly all these compoundings, I mean, all these, compoundings disappear, and why suddenly k? Huh? That's a mystery. I mean, that they made a leap of faith here. So this is, that's where I, will come into fill the gap. So first of all, we understand D1 dividend at time 1, D1, D2, D3. It's all the same thing, right? So it's D, right? But then what happened to all these, 1 plus k's? What happened to all this compounding? So let me show you how it is derived. Why the formula came to be like that. So first, it's let's start with the long polynomial, right? So intrinsic value of the perpetuity or zero growth model, of course, we have d over 1 plus k plus d over 1 plus k squared plus d over 1 plus, you understand why it's k. K stands for cost of capital. In this example, is cost of equity, right? In other words, it's the required return plus ellipsis, right? That, because, you know, we go forever like this. And then because it goes to infinity, we'll have dividend at infinity minus 1, at time infinity, infinity minus 1. So then we discount it by 1 plus k over infinity minus 1. Now, of course, theoretically, infinity goes on forever, right? So it's, you might wonder, is it meaningful at all? Is it meaningful at all to have, you know, infinity, price at infinity, price at infinite time. Oh, I'm sorry, that minus 1 shouldn't be like that. What was I thinking? Okay. It should be infinity minus 1, right? And then this will be 1 plus k raised to infinity. Actually, I would rather write it like this. I would separate. I would separate d at infinity and price at infinite time, right? Discounted by 1 plus k raised to infinity. Now, think about it. And I will call this equation, equation number 1. I will call this that takes too much time. I'll just use okay, I'll call that equation number 1. Now, first of all, let's think about this. What is the meaning of, is it meaningful? I mean, price at infinite time, is it meaningful? Suppose, you know, we all know Apple, let's say, you know, whatever stock. Let's look up the price of any stock today, and probably, you know, Apple, maybe whatever, you know, today the market was good, right? But it didn't see only Nasdaq only 1.5% gain. I mean, over the last couple of days, I mean, starting from like I think last Friday. I mean, from last Friday, it's been like a nosedive. I mean, it didn't, but it almost lost. We almost lost like 1.3% every day. 1.3% every day. But only from yesterday, it rebounded. But rebound was like only about 1.3% per day. To regain what we've lost over the last couple of days, it would take more than 1.345% per day. But anyway, let's pick a stock, something like Apple. I have okay, Apple. Look at just 1 year time frame, daily. This is daily, but I want to. Okay, daily. That's fine because this was when because this is daily since October. This was only. This was only. This was when. This was like September 8th. September 8th, I think it was. But then it started to drop and hit the bottom on like this Monday, and then started to regain. But whatever. Let's take a look at the maximum picture. Okay, Apple. I told you Apple went public in 1981. So maximum and annual. Let's get monthly. One. Okay, year, annual. One month, monthly. Okay, still doesn't. I mean, to get a full view, we have the screen area is limited, right? So maybe annual. We'll just take a look at annual because it's been 40 years. Think about it since Apple went public. It's been 40 years, So this end of this line, it would be 1981. Okay. You see, December 1980. So, and you think the price at the time was like what? You think, 10 cents, low open 12 cents, right? 12 cents 8, right? High 16 cents, 1, low 6. Was it really like that? No. This is prorated. This is prorated price. Why? When Apple went public, actually the par value, the IPO price was like $10. Now those $10 are now truncated or prorated to 10 cents. So that's like 1/100th. I mean, everything is scaled down by 100, scaled down by 100, right? Why? Because Apple had over the years, it wasn't that much, that much, until around this time, which would be like what was that, 2006, right? And they had a success in 2006 because I think 2007 it was, the first iPhone came out in 2007, I believe. But $6. No, you should. It was like, that means it was like $68, right? I told you, it's all scaled down. Why? Because over the life of Apple, there were many splits. I mean, you see only 2 splits because it's annual. But during the even in 2000, even last year, 2020, August, they had split. And also 2014, around 2014, 2016, they had a split. I mean, think about it. If you have just 1 to 5 split, 1 to 5, one share splits into 5 shares, then think about it. If the stock price is $1,000, then if you split to 5 shares, then each stock price will be $200, right? And I think I explained this before. The reason they split is to make the price more marketable, right? To make the price more marketable, to make the stock more marketable, right? The price must be marketable. If the price is like, so there were multiple splits over the life of Apple, 40-year life of Apple. And all the prices are basically a post-split price. I mean, all the pre-split prices are prorated to match the post-split price. So currently, Apple is like 143 close price today, 143. But if there was no split, if we let Apple to think about it. If we let Apple to go on, if we had let Apple go on without any split, the price would be at least 100 times now, right? Because I told you, if IPO price was $10 and then it is only currently it is only showing as 10 cents, right? The price is prorated, factor in all these splits. So there is like 100-fold difference. 100-fold difference is 10,000%, right? 100-fold difference is 10,000%. So considering that, that means if we had no split, the price now will have to be, it is 143, right? Times 100. Try that. 143 times 100. What's it going to be? It's going to be $14,300. One share will have to trade at $14,300. Does it make sense? So then it's going to be very difficult to for average investor. It's going to be very difficult to own Apple, right? I mean, you have to have at least $20,000 to buy one share of Apple, right? That makes Apple less marketable, right? You understand? So over the life of Apple, they split over and over, so that the price is currently quite manageable. Price is marketable. On the other hand, Amazon. Let's take a look at Amazon. Amazon never split. Now it is 3,300. Let's take a look at the entire life of Amazon. Amazon went public, I guess, in early. So this is also annual currently. Maximum annual data, right? So the beginning of There was two splits, I believe, not that, but not that often. This is the beginning of Amazon. That was like 1990. Was it 2000? 97, right? 97. And there was, a 3-to-1 split, 2-to-1 split. I mean, I don't remember if there were other splits, but at least if there were two splits, there could have been more splits. But think about it: 3-to-1 at this point, right? And then 2-to-1. So at least that means sixfold, right? That means although after proration, although it looks like it is $7.64 times try times 6. If you 7 times 6, right? Almost, this is almost $8 times 6. 8 times, almost, $46, $48, right? So it was like that. And if there was no split, currently Amazon's price must be much higher, right? Then it wouldn't be, marketable. I don't know if there was, other more splits since then. I'll try monthly data, and looking at the monthly data, I don't see any split, right? Since that early, those were, those 3 splits. There were 3 splits. Here it was 2-to-1, 2-to-1, 2-to-1. So it's almost like 12-fold, right? Meaning, after making adjustment for those 12-fold, then, the IPO price, this is monthly, so monthly price. So in the first month, at the end of the first month, it was it looks like it's $1.50, but $1.50 times 12, right? $1.50 times 12. That was probably $1.50 times 12 would be something like, what happened? $18 at the end of the first month, right? $18 at the end of the first month. But at the end of the first year, it was like $48, $46, $48. Now, but the point is, why am I talking about the split? Why am I talking about as I said, split is necessary because it keeps the price marketable, right? Keeps the stock price marketable. Then think about it. Now we come back to this formula, right? In the infinite future, right? If this is Apple, there will be some price. There will be some price at infinite future. Isn't that right? What do you think the price will be like? Apple's price in infinite future. What do you think it's going to be like? Anybody? Now, let me give you like multiple choice. I mean, not multiple choice. It would be just dual choice, not multiple choice. Will in the infinite future, will the price of Apple be number one, infinitely large number, or number two, a finite number? What do you think? In the infinite future, what do you think it's going to be like? Number one or number two? Anyone? Everyone is very quiet. Akisi, are you there, Akisi? Larissa, Akisi?
Yes.
Yeah, Larissa, what do you think? What's it going to be like? In the infinite future, what's going to be the price of Apple going to be? What's the price of Apple going to be like? An infinitely large number or a finite number? What do you think?
Infinitive number.
Infinitely large number?
Yes.
What about your Anna? Anna, are you there?
Yeah, I'm here.
Yeah, what do you think? In the infinite future, the price of Apple will be an infinitely large number or a finite number?
Does it depend on the growth? Like if it has a growth rate?
Yeah, well, there will be positive growth. Apple has shown positive growth, right? It goes without saying. Apple has shown positive growth, and most likely it will continue to show positive growth through infinity. And as I told you, we looked at Apple a while ago, right? We've looked at Apple, and look, um, the growth rate of Apple is actually, over the last 40 years, price is now what? 140 as of today. 143.29, right, as of today. Then think about it. At the beginning, at IPO, it was 10 cents. I mean, again, it wasn't really 10 cents, right? It was $10, but proration, after prorating for all those stock splits, right? Making adjustments for all those stock splits, it is scaled down to 10 cents. But we can tell the holding period return is, we already know, we can easily calculate it, 143.29 minus 10 cents, 0.1 divided by 0.1. And this is the 40-year holding period return. The 40-year holding period return is 1,432 times, meaning, times 100. Then, that's percentage, right? Times 100. In terms of percentage, the growth is 143,190%, right? 143,100. But let's just forget it. We'll just we can easily tell one. If you bought Apple, I mean, if I bought one share of Apple at the time, right? Okay, I will clear this and using if I bought one share of Apple, that means I paid $10 at the time, and since it is, it is, $1,432 now, but overall growth in the, my $10 split many times. So my $10 are now, just one share is like this, but my overall return must have been, I would be like times 1,431.9 will give me, right, $14,319. Just buying, if I had bought one share of Apple in 1981, right, that one share of Apple is now how many shares? It will have to be 100 shares now. It's 100 shares, right? Isn't that right? Because one share is $143. If I have, 14,000, if my $10 investment is now 14,319, that means my one share multiplied into 100 shares, right? This is how much Apple grew over 40 years, right? That makes sense. So, and you can tell the growth rate has been like, it was immaterial until like, it looks immaterial, but because everything is scaled down, right? Obviously it was, it had a good growth, but the growth kind of soared since 2000. This is like what? The growth rate soared since 2007, December of 2007. Look how steep the annual growth rates were. So if Apple continues to grow like this in an infinite future, of course the growth rate will be, I don't know, Apple may have splits still. Most likely Apple's gonna have splits for the same reason as they had splits in the past. And after making adjustment for the splits, in the infinite future, this period, this is like 2000. Think about it. This period is 2008 through 2021. Even this period may look like this, right? If you have a very long time horizon in the infinite future, this steep growth period may even still look, very smooth like this. But one way or the other, it is quite likely. It's quite likely that Apple will have positive growth, right? It's not going to be like Apple will have negative growth anytime soon. So in an infinite future, let's say a million years later, right? A million years later, Apple will have positive growth over a million years. But then what is this number going to be? An infinitely large number or a finite number? Anyone? I mean, Anna, you said, it depends on the growth rate. Yeah, even on the growth, I said, the growth rate will be a positive 1, right? It will be a positive 1. Then, on the positive growth rate, I mean, it's already given. There's no question that the growth rate won't be positive. Will be positive. There's no question. So then, with the positive growth rate assumption, what's it going to be like? Huh? And this is, you just need to pick an infinitely large number or a finite number. Anna said it depends. Well, it's a positive growth, right? So then, if it is positive growth, what's it going to? Anthony, are you there, Anthony?
Yeah, I'm here. I'm here.
Okay, Anthony. So what do you think? Is it's going to be a positive? It's going to be an infinitely large number or a finite number?
I think it's an infinite large number.
Okay, so two people said infinitely large number. How about you, Damien? Are you there, Damien? 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 Okay, maybe Damien is not there. Ibani, are you there, Ibani? Ibani? Ibani, okay, I would have to assume she's not. Ethan, are you there, Ethan?
I'm here, Professor.
Damien.
I've been trying to. I'm here, Professor Damien. Here, yo.
Okay, Damien. All right,
Yeah,
Damien. So, what do you think? It's going to be an infinitely large number or a finite number?
I'm still trying to catch up, Professor. I wasn't here last week, so I'm still trying to just catch up. All right. You gotta excuse me, but it'll probably be a finite number.
Finite. Okay. One person said finite, and two people said, infinitely large number. Okay. Ethan, are you there, Ethan? Ethan? Yeah, I see your mic.
Yes, hi, Professor.
Yeah, so what's it going to be? Is it going to be a finite number or an infinitely large number?
I think it would be like infinitely large number.
Infinitely large number. So 3 infinitely large number.
You can add
1
another one to that, Ebony.
Ibani. Okay,
Yes.
Ibani. So, what do you think? It's going to be an
Infinite.
infinitely large?
Yes.
Infinitely large. Okay. So then 4 infinitely large, 1 finite. Okay. I can do this only because there are, like 7 people. If there are like, 14 people, I can't. Giselle, are you there, Giselle? 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 I will have to assume you're not there, Giselle. Josu, are you there, Josu?
Yes, I'm here.
Okay, Josu. So what do you think? Is it going to be an infinitely large number or a finite number?
I'll say infinite large number.
Oh, okay. Why? I mean, so it's like 6 people are of 6 or 5 people said infinitely large number, and only one person, only Damien said finite number. Let me tell you, it's a finite number. Finite. Okay? Why? First of all, 2 reasons. 2 reasons why. First of all, so Damien, I'll give you 0.25. I don't know if you had a logic behind it or if you just took a lucky guess, but you got the answer, so I'll give you.
I go with a leap of faith, sir. Leap of faith.
Leap of faith. Okay.
Yes, sir.
All righty. Sometimes you cannot win the lottery by logic. Okay. Sometimes lottery, no matter what, it's a probability, right? And you are always bound to lose, because how can you beat the probability of 1 in 300 million, right? So Damien, I'll give you 0.25. Okay. Why finite number? 2 reasons. And I already gave you one reason. I explained one. What about all those splits? Huh? Apple had multiple splits over 40-year history. Over its 40-year life so far, Apple had multiple splits. And why did I say they had a split? Why did I say they had those splits? Does anyone remember?
To reduce the price, Professor, so it could be more tradable for the
Yeah. Who said that?
Anthony Neuer.
Anthony. So
Yeah,
I'm going to
hoping
give
that's
you
some
Anthony.
points today for participation. Thank you.
Anthony, yeah, I'll give you 0.25. Yes, I already told you.
Appreciate it.
if Apple didn't have any splits, the price would be like, by now the price will be, 14,000 something, right? 14,300 something if Apple hadn't any splits. Remember? But they had splits. At least, in the life of 40-year life of Apple, they had at least like 6 splits or, 6, 7. And why did they have splits? To make the price more tradable, marketable, more marketable. So even in millionaires, reason number 1, even in millionaires, the price won't be an infinitely large number. Think about any stock that's trading for $10 million. Who's going to buy that stock? Who can buy that stock? Only billionaires can own like 100. Using billionaires, using all their fortune. If I'm a billionaire, I have let's say my net worth is $1 billion. With $1 billion, how many $10 million stocks can I buy? Using all my wealth, I can only buy 100 shares. Does that make any sense?
No.
Of course not, because who would buy, in the stock market, even in millionaires, not everyone will be billionaires. There are 300 million people in the United States. In 1 million years, will all of these 300 people become millionaires? No, there will still be, top 1% wealthy. There will still be, bottom, 99% and bottom 10%. Look, even in these income disparity will get, income disparity will get bigger and bigger and bigger unless we do something about this capitalist system, right? Unless this unruly, right? Unbridled, unchecked, right? Capitalist system, 1% richer, 1% wealthy will get, richer. They become 0.1% wealth group, 0.1% group, and the bottom 10%, bottom 50% will get, worse. They will be worse off because it's called, entry barrier, rent seeking and entry barrier. If you're top 1%, you'll try to secure your top 1% position more and more. And the resources and the wealth created by limited resources are also limited. Think about it. The wealth created by limited resources are also limited. And they just funnel all that wealth to themselves. Jeff Bezos, think about it. Amazon is a $2 trillion company. Market capitalization of Amazon is like $2 trillion. Apple also $2 trillion. $2 trillion is like the GDP of UK, slightly less than the GDP of UK. You understand? $2 trillion is greater than the GDP of France. Maybe not France. France may be greater than South Korea or Italy. South Korea and Italy would be about 1.5 trillion to 1.8 trillion. And think about it. $2 trillion, their market capitalization, in other words, their value of their, of course, market capitalization doesn't mean it belongs to Amazon, but you have to look at the total asset size of Amazon. But the market, the equity value in the market is more than $2 trillion. That's greater than the size of some a decent OECD, right? Industrialized economy. But then, if Amazon is that profitable, where does the profit go to? It doesn't it goes to the shareholders, of course, goes to the shareholders. But that means that doesn't mean they are distributing those profit to show. They don't have to. I told you before, if you want to recoup your profit, you can simply sell, right? If you're the shareholder, Amazon shareholder, you can simply sell and you can recoup. But someone like me, I have, I don't even have any Amazon shares, but I have Apple shares, like 50 shares, then, but I'm not I'm a minority shareholder. I'm a minority shareholder. Of course, if Apple makes a big profit, then good for me because my stock price will go up. But then the profit that the company makes is not distributed to the employees. You understand? Because profit doesn't belong to the employees. Profit belongs to the shareholders. And it's the majority shareholders that benefit. Who are the majority shareholders? The big monies, right? Big institutional investors. They are, majority shareholders and they benefit, right? Institutional.
Yes.
Of course, my retirement fund. My retirement fund is part of the institutional investors. But in other words, who holds largest shares of Apple? Some asset management firms, asset management firms like Goldman Sachs, BlackRock, asset management firms, that are holding and whose money are they managing? Top 1%, right? For example, BlackRock or Goldman Sachs, BlackRock, these asset management firms may hold like 15%, 20% of Apple shares, and then when Apple makes profit, that profit belongs to them. And these wealth management firms, they are managing the money of top 0.1% and top 1%. So all that profit goes to the top 1%, top 0.1%. So income disparity will get, when Apple makes money, income disparity will get bigger because those who work for Apple, of course, look at Amazon. If Amazon makes money, Amazon makes profit, that profit goes to the wealth management firms, which is, managing the money of top 0.1% or top 1%, right? And the Amazon workers, of course, there are Amazon workers in the Amazon who are not working in the warehouse, but a lot of them are basically warehouse staff. And warehouse workers, they are sweatshopped, and they are getting like not even $15 an hour, right? But by sweatshopping, the profit margin, by sweatshopping the workers, the profit margin gets bigger, right? Think about it. There are two ways to maximize profit. One, holding the cost constant, maximizing the revenue. I mean, when you increase the revenue, holding the cost constant, right? Revenue minus cost is profit. So profit increase. Second way, revenue doesn't increase that much. I mean, if the economy is, if the economy is going through a recession, then revenue cannot grow much, right? Because people are not spending. I mean, spending goes down, revenue goes down. But then, when revenue goes down, or or let's say revenue isn't growing, right? If revenue isn't growing, then still to maximize profit, what do? Then hold the cost down, lower the cost. lowering the cost. And think about it. Even it makes sense if the economy is not growing and if the economy is in recession, then it makes sense to okay, you have to please the shareholders, because if you don't please the shareholders, then what happens? They will sell the stocks, they will sell the shares, and stock price will plummet. They don't want that. The goal of the business, I told you, goal of the business is to maximize profit. But if to put it slightly differently, the goal of all the businesses is to maximize the shareholder wealth, shareholder value, right? So they will try, the management will try their best to maximize the shareholder wealth, and then they will keep their job. If they fail at that objective, then they get fired, right? The management will get fired by the board of directors, and the board of directors will hire new management that will serve their goal, right? They serve, basically the management serves at the pleasure of the owners, right? Owners are represented by board of directors, right? So think about it. During the bad economy, then revenue cannot go up. Okay, so it makes sense, that not to. It makes sense if the revenue isn't going up. It makes sense to keep the cost low, right, at a constant level, right? Because at least they want to defend, that profit margin, give, existing profit margin, and probably cut the cost more, right? Because the revenue is going down, then they will have to cut the cost. Cutting the cost means, laying off people, or because wages can even go down, right? If it worse comes to worse, wages rarely go down. Once the wages have come up, then it will rarely go down, and also because of the laws like minimum wages, the laws protect the minimum wages. That's why they are fighting so hard. In the Congress, that's why the Republicans are fighting so hard to veto. Right? They are in the Congress, Republicans are fighting so hard to hold down the minimum wage. Why? Because they are lobbied by moneyed special interests. Who are the moneyed special interests? Large corporations, top 1%. They want to keep the wages low so that the profit margin will be bigger. You understand? That's why Republicans are fighting so hard. Democrats are fighting so hard to raise the minimum wages. But the Republicans are. I've been telling you, Mitch McConnell is the public enemy number one. Donald Trump is also public enemy number one. They are, during the Donald Trump administration, they undid all the regulations that were introduced to protect the consumers and protect the 99%. They undid all of them. They put all these people that were like lobbyists of the industry to the secretaries of, for example, isn't that ridiculous? The secretary, the director of EPA, Environmental Protection Agency, was under Trump administration, was the lobbyist who was lobbying for all these polluting industries. So once someone like that is put into that director position of the EPA, what would he do? He would kill off, he downsized the EPA, right? Laid off a lot of people in EPA, downsized the EPA, right? Everything was like that. They put someone who has no experience in education to the Secretary of Education, Betsy DeVos, who has no experience in education, they put her to the position of Secretary of Education. What she did was cutting down all public funding for public schools, cutting down all public funding, and trying to and then she like for-profit schools. She made it easier for the for-profit schools to prosper. For-profit schools are schools like there are online universities like DeVry, Walden, and there was a lot of controversy about them because they are only pursuing profit. So they give you still they give you good for nothing. I mean, they give you training classes that's good for nothing, and then they give you a degree taking your money, and then those degrees are useless. That's for-profit education, and then also for the director of or the secretary of director or secretary of U.S. Postal Service, they put someone who put U.S. Postal Service back by decades to sabotage mail-in vote, right? To sabotage the mail-in vote, right? Because Donald Trump wanted to sabotage the mail-in vote. All Republicans wanted to sabotage the mail-in vote. They called it fraud, and they put this guy, DeJoy, what was his name? DeJoy. They put this guy to the head of the U.S. Postal Service, and all those ballot boxes, mail, those, it was all scrapped. I mean, they were good, and for neglecting maintenance of all those things, then it became useless, and the mail-in vote was totally defunct. I mean they so this is the I mean, I digressed a lot again. I digressed. I know we were not going to this. Why did I digress? Huh? Let's go back. So yeah, I was talking about Amazon. Look, so it's understandable during the recession. I mean, because revenue isn't increasing, cutting down on the costs, so they lay off people, and that makes sense. It's recession. At least you have an excuse. But during a good economy, then revenue is increasing. Then can't you at least because revenue is increasing, can't you raise the wages? I mean, cost may go up a little during the good economy, but even during the good economy, they don't increase the cost. They don't let the they don't give higher wages during the. They still keep the wages low during the good economy, so that the profit will be maximized more than ever. And then it goes to whom? Only the top 1%, top 0.1%, right? So this all came out. This all came about because even in million years, these 300 million people in the U.S., this entire population, income gap won't close. Income gap won't close, right? Wealth gap won't close as long as they let the this unbridled, unchecked capitalist system go on. It has to, just like democracy. There's check and balance, huh? And then they see a free market economy. We are in a free market economy. Let the market decide everything. No, if you let the market decide everything, the free market economy is not perfect. It's not a perfect system. right? If you let it run wild, then only the wealthy will do, and they are in a better position. They have power to make things favorable for them. They will lobby the legislators. They will lobby the legislators to write laws to beef up their vested right. Right? Only enhanced. They will, so that they will lobby the give money to the legislators, mostly Republicans. Democrats take money too, but mostly Republicans, and Donald Trump, and people like Donald Trump, Mitch McConnell. NRA is the biggest donor to Mitch McConnell, and if you leave it there, the game is rigged, because the wealthy, they can pay they can hire lobbyists and pay the politicians to write laws that will only protect their vested interest at the expense of 99%. And as I said, wealth created by this economy is also limited, because this economy has limited resources. So whatever wealth created by the limited resources is also limited. But the top 1% wants to. They own most of it, and they want more. If they are not like that, then look, Jeff Bezos himself is like, he alone is like more than $200 million wealthy. He's worth more than $200 million. Maybe more than that, $2 billion. I'm not sure. Amazon is $2 trillion company. Jeff Bezos, 200 million? No, more than that. More than that, of course. I would say 200 billion. 200 billion, right? 200 billion, not million. 200 billion. He is worth 200 billion. I mean, it's an obscene amount of money. I mean, he can pay. I mean, just by 1% of that, by paying 1% of 200 billion, right? It's just 2 billion. It's just 1%. With that, Amazon workers can get a pay raise. Every Amazon warehouse worker can get 100% pay raise, more than that. Walmart, owned by Walton family. Walmart employees have to live on food stamp. Why? Because they are not paid enough. They are paid, a subsistence wage. So they live off food stamp. Food stamp comes from where? Where does the food stamp come from? Anyone? Where does the food stamp come from? Taxpayers' money. So instead of, we are supporting, Walmart employees rather than, Walton family, the owners of Walmart, right? It should be the Walton family, the owners of Walmart, to support their workers, not by taxpayers' money. You understand? This is how the system is rigged. If the system is not rigged, then free market will function as it's supposed to function. But the free market fails to function the way it should. It's called market failure because the system is rigged. And then they all talk about, free market, blah, blah, I'm a, supporter of, free. Look, when there is market failure, right, there has to be checks and balances, and that's the regulation, right? And 2008 financial crisis, it came about, it broke out because there was a deregulation about the of the financial market. The regulation that was in place for almost 60 years, 70 years, the Glass-Steagall Act was deregulated in late 1990s, and 10 years after, like 98, it was deregulated, and then 10 years after that, financial crisis. So the market isn't perfect. There must be checks and balances for the unbridled, unchecked, unbridled, capitalism. But back to our question. I said, it will be a finite number. Why? Two reasons. One, there will be splits constantly. There will be splits to make the stock price affordable, right? To make the stock more tradable and marketable, right? Two, economy doesn't grow in a linear pattern forever. In other words, economic growth goes through a cycle, right? So there was, 5% growth, annually for, let's say, 8 years. I mean, 5% is already too big. But then, then there is a recession. Economy cools off, and recession goes on for about 2 quarters, 3 quarters, maximum 4 quarters, and then it starts to recover. So look, the growth rate is positive for a number of years, and then negative for a couple of quarters, 1 year, and then positive again. So in other words, so overall it will be an upsloping. Overall, it's going to be an upsloping curve, but looking by a shorter time frame, there's a cycle, and because of the cycle, right, boom and bust cycle. The second reason why the price won't just grow infinitely. You understand? So because of these two reasons, this is not going to be an infinitely large number. So it's going to be a finite number. And if it is a finite number, now what is this going to be? 1 plus k raised to infinity. What's it going to be like? Is it going to be an infinitely large number, or is it going to be a finite number? Anyone? Where do I? Someone said something. Who said something? Damien? Was it Damien or Anthony?
I said finite.
Was it Anthony or Damien?
Yeah, me.
Anthony?
Yep.
Please, what did you say, Anthony?
I say it's going to be a finite number.
Okay, you said finite. Anybody else?
Professor?
Yeah.
Yeah, I think it's going to be an infinite number.
You said infinitely large number?
Yes, sir.
Okay, so one person, finite number, one person, infinitely large number. We're talking about the denominator, right? 1 plus k here, 1 plus k raised to infinity, 1 plus k raised to infinity. It's 1 to 1, right? One person infinitely large, one person finite. How about your Ibani? Ibani, you have any idea? Is it going to be infinitely large number or finite number? Ibani?
I'm going to go with Damien.
Okay, you're going to go with Damien.
Yeah.
Oh, good choice. A good choice. 2 to 1, right? Infinitely
Yeah.
large. Ethan, are you there, Ethan?
Yes, I think it will be infinite number.
Infinitely large number. Okay, 3 people said infinitely large number. Giselle, are you there? Giselle?
I would say an infinite large number.
Infinite. Okay, 4 people, infinitely large number. Josu, are you there, Josu?
Yes,
What would you say? Infinitely large number or finite number?
infinite large number.
Okay, 5 to 1. Yeah, the answer is, infinitely large number. Why? Because think about it. This number is greater than 1, right? Greater than 1. Suppose, this required return is, let's say 10%, or just 5%, even 5%. So this number will be 1.05. Just do a little thought experiment. Then raise that to infinity. Any number greater than 1, any number greater than 1 raised to infinity, it will be infinitely large number. It will be infinity. Isn't that right? If it is 1 raised to infinity, it will always be 1, because it's 1. Look, 1 raised to infinity is 1 times 1 times 1 times 1 times 1 times. No matter what, it will be just 1, right? But even if it is slightly greater than 1, if you raise it to infinity, it will be an infinitely large number, right? Just do a little thought experiment. Suppose we raise suppose we raise 1.05 raised to 10 million. Let's say 10 million. Invalid input. Okay, maybe 10 million was too much. But try again. 1.05 raised to. Let me try using this. 10 million. Okay, so it cannot calculate, but 1 million, 1.05. You see, overflow. But let me you can try on your own calculator, because maybe this is just 1.05 raised to even 1,000 or 10,000. You see, that means what does this mean? You have to add 211 zeros. This is not 7.86186. It's like you have to move these. You have to move this decimal point like by 211 places, right? That means it's gonna be a huge number, right? So then think about it. This becomes so it takes a lot of time, actually. I cannot do this in the main lecture because of the time constraint, but because this is a review and reflection, I can have this type of thought experiment. So this is going to be an infinity. Then this is a finite number, finite. Some finite number. You divide a finite number by an infinity, what's it going to be? Divide a finite number by infinity, what's it going to be? What's going to be the value of this fraction? Anyone?
Finite number.
A finite number? Yeah, it's a finite number in a way. But what kind of finite number is it going to be? You're dividing a finite number by an infinitely large number. Just do a little thought experiments. Divide 10 by, or divide 1,000. It doesn't matter. Divide 1,000 or divide 10 or divide 1 by infinity. What should it be like? Anyone?
Will it be like a recurring number? Something like that?
Yeah, it will be. It could be a recurring. The decimal points will be repeating, but
Right.
But the answer should be: will it be option 1 or option 2? Will it be a very small number? Will it be? Of course, it will be a very, very, very small number. Isn't that right? I already answered the question. It will be an infinitesimal number. Infinitesimal meaning infinitely small number. Infinitely small number. Isn't that right? Suppose, in other words,
So it'll be like an exponent, a negative exponent?
Yeah, negative, but the question is, um, negative exponent is division, right? Basically, negative exponent is division. So if you're basically dividing, uh, just do a little thought experiment, right? Is it that difficult? This becomes, I already told you, it's going to become an infinitesimally small number. What does that mean? It's going to become something close to zero. Isn't it right? It's going to be it's going to drop out because it's, why? Think about it. Do a little thought experiment. It's not that difficult. Where's the calculator? Simply do something like 1 divided by, right? 10 million, right? That'll be 0.001, or even, that's already a very small number, but because, numerator was 1. What if, something like 100,000 divided by infinitely large number. Infinitely large number. What's it going to be? Still 0.000000. You understand? No matter what you do, you're dividing it by infinity, then it will be close to zero. It will have to be close to zero. This is not even math. You don't have to do math. It's just logic. You don't have to do any math. It's just mathematical logic. Just by mathematical logic, you can arrive at the conclusion that it will be close to zero. And if it is close to zero, this term will drop out. We don't even have to worry about this term. You understand? Hmm? And most likely this will be like that too. But then one reason in this form. Now you understand why it's only the dividend is the only thing that is relevant, right? No, future value of the stock is needed. But first, that's equation 1. But let's multiply equation 1 by 1 plus k. Oh, Jesus, we haven't taken any break. So I'm going to have to finish early today. We haven't taken any break, so I think I will finish at like 8:15. Suppose I multiply equation 1 by 1 plus k. Okay? What does that mean? So here, what I do is okay, I'm going to have to put it somewhere else. I'm going to now you understand that. Oh, why isn't it getting erased? Okay, this whole thing becomes 0, right? This whole thing becomes 0. And then equation 2 is basically what I'm going to do is I'm going to multiply equation 1 by one plus k. And let's call this equation 2. I will multiply equation 1 by 1 plus k, and I'll call this equation 2. So this is equation 2. Then what does equation 2 look like? Left-hand side, because I'm multiplying 1 plus k, the left-hand side will be 1 plus k times v0. And in the right-hand side, this will be 1 plus k times this. Then what's going to happen? It will just become d, isn't it right? Is someone trying to speak? Why? Because it's d over 1 plus k times 1 plus k. So they will cancel out, right? Everyone is okay with this, right? Everyone is following, right?
Yes.
Okay. So I'm not going to do this again. I will just, erase that. And so the first term will just become d. Second term will become d over 1 plus k. Right? Because 1 plus k and 1 plus k will cancel out. It was squared, so you'll have 1 plus k left. The third term will become, because 1 plus k cancels out once, this becomes then 1 plus k squared and somewhere here the next term, which was d over 1 plus k to the 4th power, will become d over 1 plus k cubed, and it will go on forever like that. It will go on forever. And then here, then this term becomes d over 1 plus k raised to infinity minus 2, right? Because you'll have 1 less, right? If infinity is 100, this is 99. But 1 plus k raised to 99 will become 1 plus k raised to 98, right? Makes sense? And you get the idea. This term, this term becomes, d over 1 plus k infinity minus 1. And then because it's infinity, because it goes on forever, there will still be infinity doesn't have any end point. It will go on forever. So there will be still 1 plus k raised to infinity, right? Then now, what do we do next? Next, we will subtract 1 from 2. Next, two minus 1, we will do equation 2 minus 1. Subtracting, so that means everything here, equation 1 will change sign. You understand? Because you are subtracting equation 1, everything will be negative, right? Everything will be negative. This will be negative. Everything will be negative. The whole thing becomes negative because you're subtracting. Then, oh, what's happening? So think about it. There's going to be a giant subtraction, right? And you're subtracting. Okay, I'm not gonna. Let's do it anyway. Extend this all the way. And then, right? That means because of this minus, all the signs here are negative, right? Because we are subtracting the equation 1 from equation 2. Then what does this become? This will be the left-hand side will become 1 plus k minus 1 v0. You understand? I factor because I factored out. They are, I factored out v0, right? So this is already 1 plus k times v0, right? And this one is 1 times 0, right? 1 times 0. So if you factor out v0, then this becomes 1 plus k minus 1. So if you redistribute it back, this is going to become back to this is going to be back to 1 plus k times v0. This one will become again multiply minus v0, right? Understand? Now on the right hand side, now d will be still d, but then this and this, they will cancel out because this is negative, this is positive, they will cancel out. These two will cancel out, right? Also, there will be, a cubed term, right? D over 1 plus k raised to the third power. They will be canceled out, canceled out, canceled out. Whatever was here, d over 1 plus k raised to infinity minus 2, it will cancel out with this. It will cancel out with this. And then it will finally, these terms will cancel out, right? Then, Eventually, maybe I should make it smaller. Then on the right-hand side, all that's left on the right-hand side is d. On the left-hand side, all that's left is 1 plus k minus 1. Now, let's look into 1 plus k minus 1. I mean, we can, these are just, numbers. So I can open up the parenthesis. So it's going to be 1 plus k minus 1. So 1 and minus 1 will cancel out. You understand? Times V0 will be D. What's happening? Okay. Then rearranging neatly is going to be K times V0 is then D, dividend, right? Now then, what are we solving for here? What is our ultimate solution? What are we solving for here? Anyone? What are we solving for here? What is our unknown?
Dividend?
No.
Not the D?
Yeah, V0. We want to know the intrinsic value of this stock. We are solving for V0, right? We're trying to value this stock. So V0 is our unknown. We're solving for V0. So think about it. What's V0? This is, K times V0 is D. Then V0 is?
K, D divided by K.
Yes. And who is this?
Damien, Professor.
Okay. Did you say K divided by D?
No, D divided by
D divided by K. Yeah. Yes. So we arrived at, this is how, you see, we arrived at what? We arrived at this formula, V0 equals D over K, right? So it took so much time, but I hope you enjoyed that, thought process, because, it's not just, you shouldn't make a jump like that. I mean, don't you have any question? Don't you have a question that when, the original initial formula is like this, and after all, suddenly from this, how does it turn into this? Right? Textbooks are not talking about those steps of derivation, but that's what's behind it. That's what's behind it. It's called infinite geometric series. But by using infinite geometric series, right, we can, this is how it is derived. Okay? Of course, if you are a finance major, right? And if you are, because you're taking this course, you're all finance major, and this is a capstone course in finance. And although you are at VMCC, a 2-year school, but this course carries over to Baruch or NYU as their equivalent course. In NYU, at Baruch, this is Finance 3710, right? Even at that level, they don't necessarily show this process. This is something that you encounter on graduate level, and on graduate level, you cannot just memorize, just the formula. You need to know how the formulas are derived. right? But it's not that difficult. I mean, it's been very slow. I mean, I wasn't just throwing this at you. I had all this, background knowledge. I gave you all this background knowledge. Why the price won't, be infinitely large, even in million years, in infinite time. I gave you all that explanation, and also, supporting argument for that. I mean, everything must have supporting argument. That supporting argument must be sound and empirically proven, right? And I gave you all that. That's why it took so much time. Okay. So Damien, I will give you 0.25 for answering that, but also I will give you another 0.25 because wasn't it you who said, the numerator will be infinitely large number here, right? Damien, wasn't it you?
Yes, Professor.
Okay, and there were 5 other people who agreed with Damien, if I remember correctly. Who are those 5? Give me your names.
Anthony Noyer.
Anthony, okay.
Giselle Leon.
Giselle, okay. Giselle, you got 0.25. And who else? There were 5 people. So 5 people that went with Damien. I know. Come on. You don't want your Ethan, didn't you say you agree with Damien? Ethan. Josu, didn't you say you also agree with Damien? I mean, there were 5, but only okay. Other than Damien, 4. Only 2 came out. Only 2 came forth. Where are the other 2? Well, then so be it then. And I mean, if you don't want your credit, then so be it. So Damien, Anthony, and Giselle, you guys get 0.25 for that answer. Denominator being infinitely large number in that equation, right? And then, all right. So you might think, hey, we are really slowed down. It took a lot of time, but we can do this during the collaborate because the main lecture is already delivered by the my pre-recorded videos, and this works well. So this constant dividend model or zero growth model, also called perpetuity model, works well with preferred stocks. Why? Preferred stocks are perpetuities, right? Okay, was someone saying something?
No, I was saying the preferred stock, it has 0 growth, so that's why it's
Okay, I'm not. I couldn't hear you clearly, but I couldn't hear you clearly. But you agree, you understand that the preferred stock exactly falls into, it fits this model. Preferred stocks pay constant dividends, so it fits this model, and it goes on forever. Stocks go on forever. So we don't have it's example 13.3, and where is example 13.3? I think it was previously here. Okay, wherever that example is, we're gonna, it's not a difficult thing. Then constant dividend growth model, which is also called Gordon growth model. And the formula is, basically dividend at time 1 over K, cost of equity, right? In other words, required return minus growth rate, dividend growth rate, But then again, I will. How does everything starts? Everything starts from this, and from this, how does that turn into this? Right? We're gonna have to. We're gonna have to talk about that too, right? We're gonna have to talk about that too. But it's gonna take a long, long time. But I will show you quickly. So this means dividend is growing at a constant rate. Also, in reality, there may be cases that this fits, but not all the time this works. Not all the time. But then dividend at time one. How do we know? I mean, dividend at time one is one period at the end of one period, right? One period after. Obviously, we'll have to use the forecast, but how do we generate the forecast? Well, if we have dividend at time 0, and if we have the growth rate of the dividend, then D0 times 1 plus G will give you D1, right? So that way we can, and once we've, then, how do we know what the growth rate is? We can generate it from the data. It's not given. It's not going to be given, right? Don't expect, oh, this will be given, this will be given. No, it won't be given. You'll have to generate from the data. In this simple example, it was given, like, dividend last period was $3, and the growth rate was 8%. So, and the required return was 14%. So you do 3 times 1.08, and then 14, 0.14 minus 0.08. So it is, $54. It's not going to be this easy, because how do you know? I mean, if they give you the growth rate is 8%, I mean, first of all, is that the correct growth rate? I mean, you must wonder. And it's not always given. So we have to extract it from the data. How? So first of all, then we're going to use, this is the example for that. Oh, this is a variable growth model. But before that, let me show you how it is derived. No, I don't think it was this. Okay, it's this one. All right, so take a look at this. Think about it. If you buy stock today, right, at time t, right, you pay, this is the price of the stock, right? You pay market price, of course. So P subscript t, which is the price of the stock at time t, and it's gonna grow at the rate of k. In other words, k is the required return. It will grow at that rate, and that means if growing at k means not only that the price will be pt plus 1, but one quarter later or one period later, of course, it will have to be quarter, because stocks pay dividends quarterly, right? Or at least a quarter later, or 1 year later. 1 year later, then there will be 4 dividends. If the stock is paying dividends, there will be 4 quarterly dividends. 4 quarterly, if you sum those 4 quarterly dividends, that's annual dividend. Okay, so if this is 1 year annual price, right? Price at time 0. This is price at time 1. So in other words, if you buy this stock today, paying price at time 0, price at time t, is going to grow to price at time t plus 1, and then there will be dividend, right? And it grows at 1 plus k. So in other words, this is exactly the compounding model. Price and the return is, in this case, the return is of course k, but say you buy a stock for $100, and it will grow at required return of, let's say, 10%. Then that 10% is the actually, that will give you this return is the result. 10% is the result of dividing this by this. You understand? 1 plus 10%, 1.1 is the result of dividing this by this. I mean, that's how you calculate the return, isn't it right? Return is basically, what is return? Return is 1 plus k, or 1 plus r, right? K is the same thing as r. K means cost of capital, so cost of equity in this case. So that's the required return. It is price at time t plus 1 plus dividend at time t plus 1. Right? Everyone follows, right? Over price at time t. Isn't this what the return means, right? Isn't that right? Everyone.
Right.
Right. So then I simply put it, I solved it for, okay, that's my voice echoing. I simply solved it for I simply expressed it this way, as if I'm solving for of course, this is gross return. Just to get net return, you'll have to subtract 1 from both sides, right? I simply put it, in multiplicative form, right? Okay, you see? Then, where is it? Now you see? And then if I, again, if I solve it for k plus 1 plus k, then this is what the return is, right? And then, if there is no dividend, in other words, suppose, if there was no dividend, then there would only be capital gains. If there was no dividend, then this is not k, but this is g. Okay, it's just the growth rate of the capital gains. It's just the growth rate of the price. You understand? If there was no dividend, the difference between the return and the growth is the return has additional cash flow like dividend, whereas growth rate doesn't have any additional cash flow. Okay? Make sense? Now, so this is the difference between G and K. Now, but we know PT plus 1 is PT times 1 plus growth rate. Yeah, that's what I just explained. If there's only growth in the price, then it's the growth rate, right? PT plus 1 is simply, PT plus 1 is PT times 1 plus G, right? So I can express it PT plus 1 as PT times 1 plus G times DT plus 1, okay? And the right-hand side remains the same. In the left-hand side, PT and PT cancels out. PT and PT cancels out. Isn't that right? This PT and PT cancels out. So I'm left with only 1 plus G, right? And then DT plus 1 over PT. I mean, because this denominator is the denominator for both terms, right? This cancels out with this PT, but so it's going to be, this term will be 1 plus G, but this one will still remain the same, right? So then I'm here. The right-hand side is still the same, and then you think about it. If you move this to the right-hand side, right? Move this to the right-hand side, they will be all negative, right? 1 and 1 will cancel out. This will be K minus G, K minus G. And then the right-hand side, left-hand side, we have DT plus 1 over PT. Then solving this for PT, because we want to, PT is the price now, price today, right? Of course, this eventually, if this is the rational, because this is the rational price, this will be written as V0 or VT later. But, you know, based on this, solving this equation for PT, then it will have to be, right, DT plus 1 over K minus G. K, you know, is the same thing as required R. Okay, so everyone follows? Everyone understands why the formula looks this way? Huh? Why Gordon growth model looks that way? It's not just, you know, it just didn't drop from the, it just didn't drop from the sky. It didn't just, you know, it wasn't conjured from, you know, thin air.
Professor?
There's a, I'm sorry.
Yeah,
Did you say
Professor?
something?
Yeah. Can you go back to the other slide?
What other slide? You mean
the one that was breaking
this
down
one?
the formula?
Oh, yeah. This one?
Yeah. I have a question.
Yeah.
So in the last line, PT equals DT plus 1. So in the previous line before that, wouldn't you, to get PT, wouldn't you multiply by DT plus 1 and then do it on the other side? So why is it like on top of?
Look.
Like, how did you get PT alone in the last part?
Look, okay. So think about it. If everything is, you know, if z equals x times y, what does that mean? Z divided by x is y. Isn't that right? Or also, z divided by y is x, right?
Okay.
You wanna In other words, if 12 is 3 times 4, right? We know 12 divided by 3 will be 4, or 12 divided by 3 will be 4 will be 3. I mean, basically, so we have here dt plus 1 over pt is k minus g, right? So this is like z, right? This is like x, this is like y. Suppose you're solving this equation for then x. I mean, if you're solving it for x, right? And think about it. This is like 12, this is like 3, this is like 4. If you want to find 3, you'll have to divide 12 by 3, right? So then,
Okay.
because, right? I mean, if this is, 12, if this is 3, if this is 4, you want to know 3, you'll have to divide 12 by 4. Isn't that right?
Okay, yeah.
Yeah, thus the formula, right? Again, this is what I discovered when I was a graduate student, because when I was a graduate student, it really, bothered me. It really bothered me. Why? I mean, how does that formula turn into, I mean, it was originally, they all start from this, basically. They all start from this, right? And I learned, how to do the infinite geometric series, right? So, I practiced and practiced the infinite geometric series. So I got good at that. I could derive, right? I could do it easily. But then this still bothered me. It bothered me so much. It's like a pet peeve for me. Not, if there is a missing link, for me, it's my pet peeve. I have to find that pet peeve, that missing link. So for me, that's the pet peeve. So I wrap my head around it over and over. This was developed by Professor Gordon back in 1950s, and I don't know when he developed this. I don't know if he developed it this way or other way. I never got a handle on his original paper. I just always thought this is all just algebra. I can crack it, and then I cracked it. Whether and so Professor Gordon passed away I believe in 1990s, but his model, this was like a monument in finance, and I was, where did this come from? I mean, it's 1 plus g, and 1 plus k. It's been always 1 plus k. Where did suddenly minus g come from? Why is it minus g? Couldn't it be a plus g? I mean, why? And then the question was, I answered my own question. I derived this myself because I saw the difference between k and g, right? Because it cannot, if this is g, you don't have dt plus 1. I mean, if this is g, it will be simply pt times 1 plus g will be pt plus 1. But there's a difference between the growth rate and return. Return is the result of capital gains and additional cash flow. And then with that, I was able to separate it like this, and then I got to this. So this is my own method. This is my own steps of derivation that I developed on my own. Okay, so this is the why the formula is that way. Instead of just memorizing it, if you know how they are derived, then you don't have to memorize it. You can always derive it yourself, right? All right. So it's already. I was gonna finish it at 8:15 because we had no break. Actually, you know, it's 3 hours with no break. 2 hours 30 minutes with no break. This is like, you know, this is like a rock concert without any break, right?
No intermission.
Hmm?
No intermission.
No intermission. Yeah,
Yeah.
no intermission. And you know how the rock stars are, you know, really burning out, you know, themselves.
Yeah.
This is, you know, for me, this is really a burnout. What can I do? Anyway, so that's it for today. I will we couldn't, but you know, once we know this, then you know, doesn't matter, you know, if it takes more time. But next week, you know, we'll have quiz 1, which is 20% of your semester grade. All righty. I will see you guys next Thursday. Take care, everyone.
You too. Good night, Professor.
All right. Good night.
Okay.
Watch out for the
Good night.
announcement for quiz 1. Yeah. Good night.
Okay.
Good night.
Okay.
All righty. I will.
Okay.
I
Okay.
will
Bye.
stop. Bye bye. I'll
Bye.
take. I will stop sharing, stop recording, and sign out.
Okay.